Welcome back to another Market Insight. Join new frequent guest this year. I think it's 3, Dan Goeddel.
It's good to be back.
New guest. It's been 5 years.
I know.
Brian McGeehon.
The last one was so good. It took 5 years to get invited back. Thanks, Chris.
But he's an expert in labor markets. We haven't talked about them in a while, and that's making the headlines. So hopefully we can get you, and you have your CFA. You could dust that off and come in here and maybe say a few words before then.
Yeah. And shout out to Chris. This is episode 100 of Market Insights for Chris. So way to go.
Way to go, man. All right, guys, please help me come back sooner than 5 years. So, for YouTube, please like, subscribe, and turn on notifications. And really cool, so we're now on Apple and Spotify. So to do that, just follow, and please give us a good rating. Please give me a good rating. I would like to come back. Before the next president, ideally. So, thanks, guys.
Well, let's get into it. Okay. It's August, choppy month. Market's been a little wobbly today and yesterday. We'll talk about that, but that's normal this time of the year. We've seen this slide multiple times. August, the way we look at it, top one is up months versus down months. So there are actually a lot of up months in August. You go down, it's average increase to decrease. Then the blue line was the average actual increase. So August is actually generally a drift higher. It's September that on average is a down month. It's actually the only month that you look up top, we have more down months than positive months. So running into some volatility here would make sense. There's a lot of reasons for it. Money supply is generally one of them. There's a seasonality effect where money supply tends to come down. There's other summer things that Professor Siegel writes a lot about. Sometimes just people paying for vacations has been something written about. That's probably not it. It can be a self-fulfilling prophecy with just selling because the market's coming in.
I think this August, September might be a little bit different. We've got a potential peace deal between Russia and Ukraine, right? That's dominating the headlines. Maybe an economic tariff deal with China. Maybe at Jackson Hole, the Fed is going to announce, maybe some rate cuts. So I think we're kind of in for an atypical period. It'll be interesting to see, a couple months from now, did we land right in line with the patterns, or did all of these headlines really shift things?
And I like that you're saying maybe, because it's not one of those things that's fully priced in. Right now, and this today, we hadn't said it yet, it's Wednesday. Jackson Hole that you referenced is on Friday, and that's also when this gets released on Friday. And the talking heads tend to all seem that they think they're going to start signaling rate cuts at this meeting. I think it's probably a little early for them to do that based on what they're saying. I think they should. But they're probably not going to. And most investors think that that's probably the case. So there is this disconnect between what's actually priced in and what people are saying. And you mentioned 2 other things where there's still pessimism around that. So there is upside to if they come through. That also means there's downside if those don't end up coming through as all clear.
It's going to be interesting to see what consumer confidence has to play in this too, because this has been a wild year, emotionally. I know that I still serve a good amount of families for Gatewood, and early on this year with the tariffs and a lot of the political uncertainty, people were kind of scared to spend. And now things are looking a little bit more certain than they did a couple months ago. So it's going to be interesting if we have some pent-up, demand going into the end of the year based on some of the behaviors we saw earlier this year.
And a lot of times we joke about the market being boring, and it really has been boring, except for the last 2 days where it's just a little bit of a pullback. And a big chunk of that is the market's just run a lot, specifically in a few names. Bring back a chart we've used a few times, actually from our private equity deck, talking about just how concentrated the U.S. markets have become. It's actually a slide we have to update more often than any other slide, because you see in the yellow part, top 10% of companies now make up 40% of the index. We pulled this towards the beginning of the year. It was 36% at the time. So we're getting more concentrated with just a few names. The bottom side of the market is not performing nearly as well.
I think one question I'm getting from clients, especially with this AI boom, is how much of my investment returns are really just coming from the big 7 mega cap stocks, the main beneficiaries of this AI wave. And I think that's a risk. So I think concentration, what is it? Apple, Microsoft, Nvidia is over 20% of the S&P 500 returns.
Nvidia hit 8% of the index the other day. So
wow,
one of the largest, most concentrated the S&P has ever been. Not necessarily a bad thing from return perspective. We actually had someone the other day that was asking, they had a portfolio that got segregated somewhere else, not something we manage, and they were concerned that they hadn't rebalanced in 10 years. Mm-hmm. And well, the answer was, you took more risk, but this large trade, talking about how concentrated markets are, they're concentrated because those names did really well. Every rebalance from a return standpoint was a mistake. Of course, you take less risk once you rebalance. So it actually worked out really well in their case.
So Chris, could you maybe show us like the mega cap stocks in the S&P 500 versus the 493? Like, how have those return profiles looked, and where do we think it's going from here?
Well, let's start with just the earnings. So this is a chart that just talks about how heavy the earnings have been. To the right is a bunch of different markets talking about the returns of where they've come throughout the year. So I don't love the PE model. I've talked about that for a while because it's a one-year model instead of the life of a stock. So when you say something got cheaper from a PE standpoint, it's not really telling the full story. But this chart shows out of all of these, that light pink, the MAG 7 were the ones that actually had a decrease in their price to earnings ratio, while everything else increased throughout the year. It's just a way of saying, yeah, the stocks are up a lot. Their earnings are also growing a lot in other places.
Yeah, the red is standing out to me relative to all the other categories.
Extremely strong earnings growth. Now, it's one of those things that, where does that stop? We're getting to the point of 2000 tech bubble level again, concentration. It's well known. We've talked about the differences on here multiple times, that the businesses now that are concentrated actually do a lot better fundamentally. They have more cash flows than they used to. So there aren't reasons to say this is an absolute top, but there's certainly, we've been saying there are signs of froth.
Well, I think this is going to be later on in our discussion when it has to do with the labor market, is that, earnings, if, we had good earnings in Q2. So that's definitely playing into some of the numbers that we're going to be looking at as far as employment and business decisions around those margins and earnings. Yeah,
and I think the mega cap stocks, not only are they the beneficiaries of the AI wave in terms of what they're selling, right, like chips for Nvidia, they're also harnessing it for productivity within their own companies. So Meta said, they announced that 30% of their code is now written by AI, which is just unbelievable. But I think most companies are still in the phase of, how do we really apply these tools? What productivity gains are we really going to get? They're figuring out adoption, but I think a lot of the MAGs, they're using it and they're seeing it translate into earnings now, where I would hope the 493 can capture that coming up.
Well, you're seeing from the MAG 7 too is that they have a bigger pocketbook to recruit top talent in these areas. Mm-hmm. I know that it's very common. I'm on these calls with executives, and the first thing they're going to say is, well, we'll just have AI do it. Well, when you're running an organization with 20, 30,000 teammates, adoption's going to be hard, as far as compliance as well. So having more earnings, a bigger pocketbook. We saw Zuckerberg. I don't recall. Maybe we can look in the footnotes on how much he was willing to pay for the top AI guy.
I heard $100 million signing bonuses were getting rejected.
Unreal. So no, it's actually the numbers seem fake when you read them. But then if you actually go look, we don't have a Facebook chart, Meta chart, because you just brought this up right now. The market cap they've added because of these growth and these hires are far exceeding that. So far for shareholders, been a great investment.
But I think the big question is there overinvestment in this? Mm-hmm. Is the AI progress going to continue at a steady rate? Yeah. Or do we hit a plateau of what these large language models can really do? And what gets us afraid as investors is this like the build up to the .com bubble? Yeah. That's the question, I think, in terms of big risks, where no one knows the answer. But what truly is the promise of AI, and is there some malinvestment that's going to have to get taken out of the system at some point?
It has to. And our view has always been the same, that what you just described will happen. There's no way of knowing when it will, and make sure we're going to be taking chips off the table as we go. We mentioned Meta. We actually, in our stock strategy, trimmed it last week, and it was time to start looking to other areas that could participate that are more flat for the year versus up 20, 30%.
I mean, I think it's early, though. I definitely think it's early. I don't think that it's priced. The real productivity gains are priced in at the current moment, because I still think there's a lot of uncertainty around what jobs it's going to replace. I think we have good ideas about what jobs, but what are people actually going to do with the tools that are given? So
well, let's make a comparison to that. What Jerry made the slide. I really like the way we're doing this. This time we took the 1998, we wanted to put it around an event. So this year was tariffs. The light blue is 2025, the partial year, so it's only going to make up however many days it's been since the recovery from the bottom. And we comped that start to 1998 when there was middle of the tech bubble, still growing, people saying it's a bubble, but hasn't come nearly close to bursting yet. And a hedge fund, famous one, did blow up, LTCM, pulled the market down about 20%. So we paired that as a good start date. And then 2018, really good comps. Same president, same Fed chair we have now, same, maybe the Fed is too tight. The market was concerned about that.
Trade war with China.
Trade war, same people in play.
There's so many similarities for what we've been through this year and what we experienced at the end of 2018. And, if we remember Christmas of 2018, market's down 19%, and everyone is in the middle of the holidays like, what is going on? And that was the peak of the trade war. So I think we're in that phase right now where, that negotiation is taking place. Now, something that really encourages me for where the market could go from here, especially when you add the Fed potential pivot that I think will be announced at Jackson Hole. We'll see if I'm right. But I think rate cuts are coming just like they did in mid-2019. If you rewind the clock, you would have loved to be in equities in 2019. So I think we're kind of working through some uncertainty this year. It was Liberation Day tariffs, peace deals, interest rate policy, tax policy. All these are slowly getting cleared where you could see, okay, maybe a quarter from now, we're set up like we were at the beginning of 2019, and a strong rally is potentially coming our way.
Yeah, I think it's all based on seeing some of the productivity gains in the labor market, which we will get a chance to get you in here.
Yes.
We'll get you in here. Do want to close out the tech bubble, though, before, just to compare it, because the recovery, very close to what you said, it's been stronger here. The yellow line is what you referenced, the recovery 2018 through 2019. Mm-hmm. We stopped the chart there. It runs into COVID, where there's another pullback.
Yeah.
The dark blue line, 1998, if we kept charting it, would continue rallying another 30, 40%, because it truly was a bubble, right? Yeah. And it kept going on another year and a half or so outside the chart of here. What we're talking about here is saying, just trying to frame it as, yeah, it's rallied a lot. Both periods show there are pullbacks that happen along the way, but compared to history, could continue to keep rallying.
I think one thing different than 2019. 2019, the Fed, it was said rates are too high. They paused, and then they ultimately cut rates in the back half of the year. We're kind of at that moment now with rates where it's happening at the same time as the negotiations with China. So just like we've been experiencing quicker drawdowns, I think we could experience quicker recoveries. I know V-shaped recovery has been a common call throughout many market corrections like we did in April this year. Mm-hmm. So it's going to be really interesting to see this play out.
Let's just close with the earnings just to show if this continues, it's the backdrop of what you just described. We haven't closed it out yet. There are two big companies that we just referenced. One of them was 8% of the index still. Nvidia, they don't report till a week from today, so next Wednesday, and Broadcom the following week after that. But earnings beats. The rate is on a little bit above average. 80% are beating their estimates. And the best part here that I have shown in the green rectangle is the S&P 500. It's about 12% growth rate at the time of this chart. Beneath it, heading into the earnings season, was only expected to be about 5. So that is a large expectation of beats above that. It's a good backdrop for the market. What tends to happen, we talked about the seasonality, is now you're in this lull that earnings are done. There's not a whole lot of market moving things. People take profits, people take vacations. Try getting a hold of people the last couple of weeks. Can be tough.
They're busy.
And that can have its impact on the market, but the fundamentals still look really good.
I was really surprised by Q2. Going in, I just know at the start of Q2, there was just a lot of uncertainty, especially as you highlighted. There's been some major headline news. And, what Q2 could have been shaping out to be would be a far different experience than what we had, with how some of these companies handle tariffs, employment. So having a 12%, I think that's a win.
Well, I think Q2 it's a really interesting dichotomy between how retail investors did and how institutional investors did. Institutional, really, it's the most hated V-shaped recovery. On the retail side, retail bought the dip.
Yep.
And I think we talked about this on previous calls. Those were our clients. we were advising to put cash to work that wasn't needed for short or midterm. So, I'm glad we captured it. I'm glad we had a great Q2 for our clients this year.
Well, I think you did a call out too, Chris. When the tariffs were first announced, everyone did overreact. Obviously, no one knew what the outcome was going to be, and I know that you kind of led us into the situation where you said, "Hey, this is going to pass. These first rates aren't going to be the actual rates," and I think our clients benefited from that. So,
and think of how resilient the market has been. So, little things that have happened. The U.S. attacked Iran, and hit their nuclear sites. Like, if you asked any of us, we would have been like, "Oh man, that's going to cause a bear market." And look where we are today, close to all-time highs again.
Well, the market opened red and finished green that Monday following that. And I don't want to steal your line. You always say it in response to what businesses are always trying to do during tariffs or any period, right? They're always trying to beat earnings. They're always trying to control costs. They care about what's happening, but they're going to focus on trying to save the bottom line and their stock price.
When we had panicking clients calling in, I always reminded them about our approach to politics and markets. And over the short term, it can move things a lot. But if you compare the S&P 500 returns under Trump's first term and under Obama's term, do you know what the returns were? Identical, 16% compounding. So over the long run, politics actually matters very little to returns. It's the innovation, the technology, and the earnings growth that really propel it and determine your long-term rate of returns. Now, if you're a trader and you're watching CNBC every day, you're going to have a different experience. But for our clients that are truly long-term, we try to get them past the politics and headlines.
And we see the signs of froth, right? We're not blind to that. We know there are IPOs hitting the market, big names, and they do. Whenever there's a big tech IPO, it puts pressure on the rest of tech. People that want to buy that, and it starts running after them, they sell their tech. They rebalance a little bit. There's only so much money that's going in the market every single day. And that does have an impact to it. And so this is, the IPO window is starting to open a little bit. Could be a headwind for that, but at the same time, it's been really strong. Now those companies on a down day get absolutely fried, 10, 15, 20% down. But those are just the signs of something that the market is getting a little overheated in the time, and it digests and recovers over time.
Well, we had the ultimate sign of froth return.
What did your grandma call you and give you a stock pick?
No, I know you're joking, but that hasn't happened yet. That is one of the final signs where your grandma starts.
So Chris, as someone who still keeps contact with front advisor, like on the front lines with advisors and clients, but the ultimate sign of froth is back, and that's a new SPAC from Chamath.
Yeah. The good news is we don't have the chart, but the SPAC boom last time, which is a blank check company, it's a different way of IPOing. Someone gets money from investors and says, I'll find a private company and take them public at a predetermined time. It takes a while. Those started really booming. The last cycle, just starting. The chart shows just a pickup. And Chamath does not have a good track record of it.
He has a good track record for Chamath, not really for his investors.
No. Yes. Yeah. That's the other point, right? The sponsors make a lot of money doing it.
Yep. But I think I've even heard from some clients, not as many as maybe the pandemic when people don't have enough to do, but maybe some trading in their play accounts, is coming back. So I think the signs of froth are starting to return. So it's something that when you create hub account policy, how much cash, how many months of spending each client should have. You made a big announcement in July, so I don't know if you want to share that.
Yeah, well, that's how you defend against this, right? And you have really three courses you can do. You can refill your hubs for retirees, just those that are taking cash out. Make sure, let everyone else stay invested, and let's take some chips off the table because they're going to be spending it. They don't need to have a pullback and they have to sell. You can take profits. We talked about that. We sold some Meta and Alphabet last week through an ETF that helped reduce volatility. You could get really aggressive with that. The chart we had a little check mark. It was just a small trim. Then you can start buying fixed income and strategies. So those are really the three things you'd look to do. We've done the first, hub accounts, done a little bit of trimming on profit taking, and we have not started buying fixed income yet. But that would be the sign you continue doing if the rally continues above fundamentals.
Brian, have you seen any signs of froth with clients right now?
Really, I was thinking about that after the grandma comment, and I have not seen it yet. A lot of the clients that I've had the pleasure of working with right now, they've been more focused on other issues. They're a lot more preoccupied, it seems like. A lot going on with the real estate prices. I know that we're going to be going into that a little bit later, but their time and attention has been filled with other things other than the hot buys at the current moment.
That's a good thing.
I know. I'll wait till I hear more from your family then.
That's how we can make changes inside the portfolio. But there are other planning tools we use. We call it Fortress Gatewood, a blog that Dan actually was the author of. Tell us more.
Yeah, I think what's interesting is you look at the history of markets and dips where the market is down 5% from the high. That happens in 90% of years, and it's very common. It happens all the time. Market corrections, a little more scary, like what we had in April, where the market's down in the 10 to 20% range, about every 18 months. Our founder, John Gatewood, always used to say, you should expect it as often as your birthday. I love that line. But then you have bear markets, roughly every 5 years now. In the past 5 years, we've had two. So we've had a really tough run. But something we've done for clients is look at their financial plan, look at their portfolio, and integrate them into a stronghold, what we call Fortress Gatewood, where picture a castle and we have 3 layers of a moat around it. The outer layers are cash. So Chris was talking about our hub accounts. Our clients that are nearing retirement, where they're going to spend down their assets or they're in retirement, we look at their plan and we forecast their monthly spending, and we set aside typically two years of cash, and we have 2 advisory strategies of cash and cash alternatives that are wonderful to provide insulation, capital preservation, so that you have confidence if a bear market started right now, you don't have to even touch a bond for 2 years. Right, so then our clients do have bonds, so
But that was the example in 2022, right?
Yeah.
We had a drawdown that lasted 18 months or so,
Yeah,
and
absolutely.
we still had over 10 months of cash at the end of that, where people were comfortable saying, I don't have to touch my equities.
Yeah.
Well, I think this has been I love the title Fortress Gatewood, because we've been doing this with the hub accounts for a long time, and I find that this really resonates with our self-made people, because you get to retirement, I see it happen every month. When people retire, they're so used to getting a paycheck that they envision that paycheck should continue, and it's scary to spend down assets. So we'll talk to someone that will have $2, $5, $10, $20 million, and they get fixated on the number.
Yep.
So if they didn't have this Fortress and they didn't have the hub account, their behaviors are completely different.
Oh yeah, and just because these bear markets have been relatively quick recoveries, even the 2022 bear market you're describing in the history of markets is relatively short. Peak to trough to peak for the dot-com bubble, for the Great Recession, is years, beyond 2 years. So that's why we have the next layer of the moat. So it's not just cash and equities. We do hold fixed income. We try to hold the right amount, not too much. And how we look at this is, for our aggressive clients, we want at least 5 years worth of their spending set aside in bonds. Then take the more conservative, we go as high as 8 years of bonds. So our clients know they either have 8 or 10 years worth of recovery time, peak to trough to a new all-time high, in a hypothetical horrible bear market where we'd have to do anything with our equities. Now, the outcome for client is not just safety. It gives Chris and his team the ability to grow the purchasing power through equities. So equity investing is how you grow your real returns over inflation. The whole point of investing is to grow your purchasing power. It comes from equity investing. So our clients typically have higher cash than our competitors would allocate them, and actually less bonds and more equities. So our clients are still growing their portfolio and compounding in retirement, which feels a lot better than keeping your balance flat or slowly spending down your assets. And this is why when we talk to clients in April, when they're panicking, and you could imagine some people were really panicking. Maybe their business was bearing the brunt of tariffs. Maybe they're left-leaning politically and they're concerned about Trump. We had panicking clients, but we say, well, we actually have the Fortress set up. Let's take a step back. Let's review the Fortress we built in the good times to prepare for the bad. And guess what we convince those clients to do? At least stay invested. If not, put additional cash to work in their equities and take advantage of the dip. So this is the system we built. I encourage you to read the blog post, talk to your wealth planner about this concept, make sure it's set up properly. But this is the confidence we want to give families.
You should just go and have a little drawing for a coffee mug that says, what was that bear market protected bull market ready? Hey, that should be a total
Yeah.
giveaway. We'll talk to Chelsea on
Well,
that.
well, that's the legacy of one of our legendary traders at the firm who built a lot of our trading rules, who Chris studied under, Ted McDonald. There's always a reason to get exuberant. There's always a reason to get overly defensive, especially when you're talking to someone who's a bond manager. They're almost always paranoid. But this was a fun collaboration with you, Chris, to really marry financial planning investments like we have for hub accounts, but more broadly. And I think our clients are the big winners here.
Let's transition to. We'll get to you.
It's okay. I'm enjoying myself.
We're coming. Two things that have made the headlines. They can pull markets back a little bit. One of the main reasons they pull markets back when the president gets a little frustrated with the Fed or with the BLS for jobs.
Wait, he's frustrated with the Fed?
He has been.
Didn't know that.
It pulls away some international investors. We know our clients aren't going to get worried about that, right? It's not really going to change a whole lot. The main thing to know about the volatility that comes from the Fed, whether they cut rates in September or next year, it's not going to impact the long term. It will impact short term because traders are going to hammer it, like you said, push their shorts if they start pushing those trades out, pushing those cuts out. But in the long run, it's really not going to matter. And
yeah, I think if we have some pullbacks, those would be great buying opportunities. And the Fed has a little drama. You had two dissenting votes, which hasn't happened in decades.
Well, they do not have an easy task. I feel bad for Powell. I mean, the data that he's looking at, it's a tough position that he's in. You can make strong arguments either way on whichever direction the Fed goes and takes this.
And the other thing that's interesting to me, a lot of people coming on saying, Jackson Hole's a time, it's a symposium where they meet with academics, and oftentimes they roll out new policy or how they're going to be looking at things. The interesting thing is Powell's done in the spring.
Yeah.
Or, that's the other risk to markets in the very short term. If they don't deliver a rate cut in September, there's a chance Trump moves
Trump
forward
has
with
threatened
trying
firing Powell. He's threatened announcing his successor and trying to undermine Powell and make him a lame duck. There's going to be more drama here. I don't think it's going to be resolved quickly.
And if they don't cut rates in September, that's going to come back. Because right now the market's looking at it, and somewhere in the 70 to 90% probability, the fixed income market's saying they're probably cutting rates in September. So if they don't deliver on that, yes, that will be the headlines.
And where's the 2-year Treasury right now?
The 3.75. So it's predicting a handful of cuts over the next.
And is our base case we still expect to see one cut this year?
We started the year at 3. Now we think there will be 2. So two out of the 3 meetings will.
So
will
half
get
a
cut.
percent down.
Mm-hmm.
Interesting.
But I think that they need to see, you can look at the data either way and say, hey, they should make cuts, maybe some soft employment numbers, but we're coming after, Q2 earnings being extremely strong. We're still dealing with home prices on the rise. So there's a good argument both ways.
There is, and we mentioned the dissenters, and when you look at the panel of voters, and one of the voters is not going to be at the September meeting, she went back to school to teach. So instead
Don't
of
blame her.
a lot more money and a lot fewer headaches, yeah, that's a good decision. And we know that Trump's already announced who he wants to take that seat, but I haven't heard yet if the Senate's going to take that up. The meeting's in mid-September. Senate comes back in September. I don't know if they can get him through enough. We know he'd be a dissenter, and he'd probably dissent for calling for more than 2 cuts.
There's a couple governors that are really auditioning for the role. You got Trump tweeting loudly and carrying a big stick as usual. So.
But a lot of the other voters are on the fence. The St. Louis Fed president, he's not going to vote for a cut. Unless Powell comes out and says this is the direction we're going, then they typically fall in line and vote. But if Powell stays hard and says we're not going to he's not supporting it, you'll only see a few dissenters. You're not going to see 4 or 5 people dissent against the vote. You will probably just see the auditioners, and if they get Myron in there,
Yeah, and I think Austin Goolsbee, who certainly is left-leaning politically, he's coming out saying it's time to cut.
Yeah.
So it's going to be fun to watch this.
He's done a great job of not following his politics. Obviously worked for the Biden administration, and he's been pretty good looking at the data. And it goes to what you said. Are you looking at the data right now? Are you trying to look through where you think the data is going to be? Because that's the difference between where they're voting. Those that have dissented are trying to look through it versus saying, yeah, this is the month of data that we need to go by.
Well, I think that you have to go and look and say, okay, what impact is this going to be, 6, 12 months, a year from now? And I think Powell's done a good job. I mean, he's been dealt a very hard hand to try to navigate this with a lot of strong opinions. I can imagine sitting in his seat with how much firing's going after him. But, I think it's going to be, I think they're going to end up having to go and lower rates. I think that's what the market's expecting. I think that we'll probably at least get one more rate cut this year because that's what, I think the people want. And I think that's probably what will.
And they still have flexibility there, right? If they're at 4.25 to 4.5 now, you cut rates twice, and you said once. Yeah. You cut rates twice. You're still in a position where if things start to really weaken, you can cut rates more, or you hold them where they are for a while.
Well, how does the employment data look? How does the inflation data look? I mean, that's their dual mandate.
Well, just one other thing. I mean, one rate cut isn't going to make a difference. I mean, it's really more of a talking thing than it will actually make the difference 6 months or 12 months from now. So I just think it's like a water cooler thing where people like to talk about one rate cut versus.
There's some good papers that are talking about rate cuts are 16 to 20 months out is where you feel it, not just 6. You get the immediate reaction to how the market's going to react and financial conditions, but it working its way down the system can take over a year.
It's going to take a while. Mm-hmm. Yeah.
Let's go to labor.
All right. So you guys haven't talked about labor in years.
Why is that?
If we pulled up old videos, there was in 2023. I remember us saying we were looking at the numbers, growing all these jobs. We're like, this just doesn't seem right when you talk about hiring. They seemed really high. And we kept saying it doesn't seem this strong, but does that matter? If we're looking at the wrong number. If earnings are growing really strongly at the time, and they were. We kept saying we have our tinfoil hats on, saying these numbers don't make sense. We brought an economist to talk about it. We couldn't make any sense of it and said, all right, there's no signal here.
Yep.
Let's just ignore it. We'll talk about the unemployment rate. Is how many people are looking for a job and can't. That makes sense to use that. But just the raw job numbers, they didn't make any sense to us. We stopped talking about them.
Well, and the revisions, I think, are obviously been in the headlines. So, of the 48 jobs numbers announcements in the Biden years, do you know how many were revised downward?
I have a
45. 45 were revised downward, and the recent one with Trump and all this drama around firing that person is half of the revisions came from government jobs. So the government wasn't even able to accurately say what the job number was for itself.
And I'm not surprised by that. I know that people are suspecting foul play on one way or the other. I think that the way that number one, if anyone's ever filed their taxes, right now we're getting tax notices from tons of clients that saying, hey, supporting documents aren't there. And the reality is that they're there. We know that these systems that the government has in place are inefficient, and I think the data is bad. I think it's hard to get good data throughout the U.S., and we're seeing the results of that. But I don't think that that's a new thing. I just think that it's becoming more aware of really the systems that are in place today are highly inefficient.
Let's throw up the chart on the revisions. And what you referenced, it goes back a long time to 2004 in the chart. And it looks just like a squiggly chart. But if you actually look at it for the noise that Dan referenced, the recent years, the revisions only go one way. For the most part, they're going down. And it follows this really choppy period during COVID, which the argument is saying something happened in COVID where this model, and you said they can't even count the government jobs, which to me means they're not making tweaks to the model. There's no foul play. Their model is broken.
Yeah, what's the quality of the data feeding the model?
It's not,
right?
Right. So that would be our view, is saying fix the model.
Yep.
And Trump's view is that there's foul play. And so he's right that something's wrong here. He just doesn't have the right reason for what's wrong. And because previously the revisions did go up or down. There was good movement to both sides. When you have that, you could say, well, our model's actually working because we're actually missing. But now it's clearly a biased model from a data standpoint.
Yeah, I just think that there needs to be some type of look at the overall system to see what's causing this model to behave the way it is. And I think it has to do a lot with the systems that have been put in place for years, and the aggregation of that data. So
let's get into the actual numbers in the labor, where it's going, and maybe try to get to impact on markets, if at all.
Well, looking at this slide that showing unemployment, it's been a very interesting year. I think that the reason you really haven't talked about labor markets is that to your point, there hasn't really been a big trend that's been taking place. 2 months ago, we had pretty bad numbers. Last month was not bad numbers. Some people are saying that there's some weakening happening in the labor markets. But, when you're looking at the chart that, I think this was from Goldman Sachs, that's showing the share of unemployment, it's staying relatively, over the last couple of years, pretty consistent. We're seeing the baby boomers entering retirement. We're seeing the millennials moving into those jobs. So I think it's been, a pretty static employment situation. My major concern isn't these next 5 years, it's what's going to happen in the next 10 years, because the labor market is going to be a lot different in the next 10 to 20 years, mainly because the birth rate. There's going to be less labor force participation, in the next 10 years.
Well, I think there's two other things. We have the wealth effect, right? The baby boomers are going to be the wealthiest generation in history, so why work a couple more years or a job you don't love if you're ready to retire right now, right? So I think that's a play, but we also have Gen Z entering the workforce. In the chart on the right you shared, Brian, I think, in particular, from my perspective, I've got a big heart for these kids graduating school and not getting jobs. I mean, we're one firm to one family, so we have a lot of Gen Z clients, and we're in the loop with families and what they're going through. There was a huge article in the Wall Street Journal on this, but I think new grads are having a really tough time, and maybe it's AI, maybe it's not, but I think there's a really tough moment going on for those college graduates.
Oh, absolutely. I mean, we're seeing it in our hiring at Gatewood. The entry-level positions, we'll have 100 people apply to be to join the team. Now, what we're seeing is on the higher positions, and this is across the board, is that those are a little bit tougher to fill. What the data is also saying is that the job hoppers, that's not really happening right now. There's not much of a premium taking place. So all of this has to be kind of looked at back in the last, this last year too. We had a new president, we had tariffs being announced, we have a new tax bill. So a lot of this has to do with the time a company, has to make a decision on the hiring process. I think a lot of the decisions these last several months have been, hey, let's kind of wait to see what happens.
And maybe they were made in Q4 of last year, which was an election. So like now we've got Q4 coming up, where companies are going to set their budgets and hiring plans for next year. How do you think that's going to play out? Do you think it's going to be caution, status quo? Like, what do you guys see?
I'm optimistic because we're coming off great earnings, in Q2. We're starting to see what the tariffs are actually going to look like. We have the tax bill that passed, so the unknown has become known. I think that a lot of the business going into next year, there's less uncertainty going into 2026 as there was going into 2025. So I do think that we might see more, employment next year with the hiring plans. I also think that the labor market is definitely divided. I mean, the other chart to the right, you see college degree versus no college degree. The skilled labor is in high demand. There's a high school here in St. Louis called St. Dominic. They're building a whole new facility just for the trades. The trades are in high demand. So I definitely think that, these next several years, there's going to be jobs that are winners, clearly. I think those broad degrees are going to be struggling for a while. I think that's what is also showing up in the data.
I think that's a great point, Brian. I think companies have lacked confidence for their hiring plans. And I think maybe AI has been a scapegoat for either shift in plans, or job cuts.
Pausing, right? You don't know. Are you going to hire this job knowing maybe AI can fill it, maybe it can't? I'm in the position for and talking to people in my role, big firms that are just paused hiring analysts. They don't need, for now, we're good.
Yeah, and I think, the piece I'm most concerned about are some of the big 5 personality traits in these surveys that are coming out. So the biggest predictor of the big 5 personality traits, the biggest predictor of how great of an employee someone is going to be, how professional, how much they'll follow through and work on, is trait conscientiousness. And that's in free fall. And if you look, Gen Z is really struggling with this. You know, it looks like everybody's kind of going in the wrong direction on a couple of these. But for us, we still find the superstars in Gen Z to come work at Gatewood. But this looks like a broader cultural shift. And Chris, you know, I want to also share the chart on 30-year-olds that are married and homeowners. So there was another chart.
Well, Dan, before we jump into that,
let's go.
So this chart, the time period that's over, it's COVID.
Yeah.
I mean, it's interesting. These kids that are 16 through 39, they grew up with social media. They grew up online. You know, through COVID, you know, we do a lot of work with Fortune, 50, Fortune 100 executives. One of the biggest things that they were struggling with is that the interaction, you know, people will go and say things over email that they would never say to another person in real life.
Yep.
So there's these huge companies in town that said, hey, we have to get people back in the office so that way they quit acting like jerks, you know?
Yeah.
And I think it's a learned skill. It's how do you actually deal with people?
And we've seen at our own company, you know, we've harnessed AI to be more productive, especially on the front lines at the advisor level. But when it goes to back office, whether it's the operations and technology team or Chris, the investment team, we have fewer openings at entry-level positions because of AI. So, you know, but I think AI is a factor. I think the quality of the applicant pool and some of these bigger societal trends and shifts is a problem. But pull up the...
I want to go there. I've been quiet, but I'm afraid that my answer might be where I started, which is the impact to the stock market may be minimal. Maybe we have an unemployment rate that moves up a little bit and gets more into a normalized, maybe it's 5%, 5 to 6 versus in the low 4s. And if companies are being more productive, we're still able to grow earnings, we're still able to grow the economy. Maybe this discussion is more related to the things you're talking about that are feelings and emotions based. And I'm not so sure it's going to have a big impact on stocks, and maybe we won't be talking much about it.
It definitely has to do with hiring plans, though, because you know I see a lot of the. You guys made this comment too, the wealth effect. You know, you're seeing a lot of people in their late 50s, 60s. You know, they've grew up in a workplace that is far different than what it is today. And they have enough money to retire. They say, you know, I just don't want to deal with this anymore.
Yeah, it's pretty common in client meetings at our firm that we're moving up the retirement date for clients.
Yeah.
You know, they're not going to run out of money. They can meet all the spending needs for the rest of their life. They can be generous. They're going to have a great legacy. Why put up with the headaches, you know, and some of the dynamics of working post-COVID if you don't need to, right?
So I definitely think it's going to be our opportunity as you know, a country and society to go and figure out, well, if these are the traits that people are behaving, you know, how do we work within that in the workplace? How do we harness those superpowers to where people still win? So,
yeah, but I do think COVID accelerated a lot of trends that already existed. So this chart is 30-year-olds who are both married and own a home. And you can see since the 1960s, where it was a little over 50%, it's tanked down to roughly 10% now. And part of this is due to home prices. I don't know if you want to show that chart, but here in our own backyard in St. Louis, you know, the house I bought in 2019 for, you know, roughly 400 to 500,000 range now is 900 to $1 million, and the payment is at a much higher interest rate. So I think, you know, first-time home buyers are really being boxed out as well.
this is where, if you ask what I've spent the most time on over the last, I would say, year and a half, why you haven't had me on the show in 5 years, is that the retirees, you know, the questions that they're asking now is, hey, how can I help my kids? And the kids, what they're looking at, didn't do anything wrong. You know, the kids got college degrees, they're working at good companies, but they've realized is that, you know, a home on the coast is almost unattainable. Mm-hmm. So a lot of our retirees are now having to allocate funds as early retirement, as early inheritance, or, you know, extra cash to their kids just to make, you know, the month-to-month work. So we've been really involved. We have a great partner at Goldman Sachs that does all of our lending, and we've been doing a lot of intergenerational lending.
Yeah, and I think we monitor our client spending, and over the past 3 years, our client spending from their accounts has been a little bit over double what it was for all of history.
Yeah.
So, I think you've seen, whether it's inflation or aspects like these, the draw rates off portfolios have really been a lot more than what people expected.
But they're going towards the kids a lot of times. It's going to, hey, I'm going to go and help my kid, finance a house at lower interest rates, and use some of advanced giving to help it be obtainable to where they can start their family. Now the average American can't do that, obviously, but we're fortunate.
That's the point. When Dan
do
sent me the home price chart, it said it's a classic chart crime. It's one thing. It's an asset price that moved up, but
and not adjusted for inflation.
Not adjusted for inflation. Not adjusted for wealth. If you divided it by gold, pricing it in real dollars, it's actually going down. Right? So but that assumes that you have something that's gone up in value, whether it's your portfolio.
Yeah, and a first-time home buyer isn't sitting on a portfolio of assets, and their income is not growing at this rate.
No.
Right?
I mean, if you look in St. Louis to try to find a $400,000 house right now, you're bidding against so many people at this point. And I think that this is what the apartment builders are banking on, is that this trend continues, that homes continue to go up in price to make it unattainable to where they're getting rent. So it's definitely here in St. Louis isn't as bad as what's happening in Florida, California, New York, Texas, Denver, these hot cities. It would be interesting to see what those home prices are average.
We'll bring you back on later to talk about
Right,
it. 5 years. Now we'll do it in a couple months. To close that out, a big reason to this is the money supply. Big jump during COVID. You can go back and this is just M2, basic money supply growth. Huge jump over 20% annualized. Big pullback in that, and good sign is actually bottoming out and coming back. The long-term average growth rate somewhere around 6%. That's very healthy for markets. Keeps as long as you're having productivity gains. Inflation can stay in that 2 to 3% range without spiking significantly, as long as we have some of those backdrops of technology. Now the tariffs do pause that a little bit.
It looks like we're getting pretty close to the long-term average, Chris.
We're close to the long-term average, which is a great backdrop for markets with the lending environment. As long as short-term rates coming down, the cost for banks, long-term rates staying in a reasonable spot, it's actually a good lending environment. It's a great backdrop for markets.
The community banks, they've had so much loan growth at this point, and they're competing for composites and having to borrow for composites to be able to maintain their loan portfolio. I'm on the board of a local community bank. They're not doing any more loans. They said their loan portfolio has grown to the point where at this point it's, hey, they just want to go and maintain.
Yeah, it's because they're constrained by their leverage ratios. They need more deposits, but they have to pay 4.25% for those deposits because they're not J.P. Morgan, who pays under 1% for their deposits, but they're then loaning it out at similar rates.
So this goes into labor markets, though, because one point I meant to make before is that your margins, your capital can dictate the speed of what you can make decisions by. So we're seeing the larger companies continue to add employment while what's Facebook's leverage ratio?
They're making a lot of money on their cash compared to what they pay out on.
They don't have to go and behave in a way to where they have to quickly, do job layoffs. They have enough margin there. They have enough capital to go and see, hey, a quarter or two down the road, what's the real impact this is going to make? Now, for these startup businesses, for these, younger mature businesses where your cash flow margin, and this is what we're helping at Gatewood Tax and Accounting, the new tax company we started, which I'm really excited about, is that, if your cash flow margins are low, well, you don't have the luxury of waiting a quarter. You might not have a quarter. So you have to respond to these headline events a lot quicker. So I definitely think that with the employment market, we saw the smaller companies not add jobs. We saw the smaller companies not add so much, but it has to do with your operating leverage.
So Chris, given all these dynamics, and especially with M2 kind of normalizing long-term average, where does your end of year kind of projection and prediction land now relative to where we started the year?
I think it supports long-term averages, getting back to normalized markets, 8 to on the high end, 14% returns that you can get in these markets with the backdrop that we just described. There's a lot of rotations happening in the market that just to be aware of for us internally. That can last, it can be a couple days or it can be a new trend. It's pretty amazing how what's happened over one day, this idea that cutting rates, which has historically been good for many of the companies we've talked about today, but they've run so much that people are just saying, I got to sell those and I got to go buy small caps, I got to go buy home builders, and Buffett just bought home builders, so I need to too. And so there's all these things that can cause short-term rotations, but the long-term trend of everything we just described, I think, is still in place for healthy markets.
Since 2024, so for every baby boomer that is out there that said, hey, back at my time, I worked, well, you finally have a chart to go and show it to people. So, the younger generation, on average, is working less than what was before. Is that AI? So if you're having greater productivity, but working less, do they...
Neutral.
I mean, so this is what it's going to... I'm just interested to see what happens in the next 5 years. With all this AI enhancement, are people going down to a 35-hour work week?
There's a great meme that goes and has headlines from every decade over the last 100 years, and in every headline it says, people just don't want to work anymore.
I mean,
so I think the older generation always feels like that, but here's some hard
here's
data.
a chart.
So
I thought that, all the baby boomers out there might enjoy
is
that
this
one.
ultimately going to translate into higher earnings and more productivity, or a 4-day work week?
Time will tell.
Thank you for joining us. We'll come back next month and see if anything Brian gave us was accurate. See you next month.